Alrighty, folks, the Fed has started their meeting. We will hear the results tomorrow, I think at 11 o'clock Pacific, 2 o'clock Eastern. Likely to be a rate cut, but will it be a hawkish cut, as so many expect? Will the dot plot, which again we do get this time, will it talk about how many cuts next year? What is going on with the economic data that we're getting now that the government shutdown is over? It's a lot of delayed information. And what is set up for 2026? Anna, how you doing? I know you read a lot of stuff. What's crossed your paths in the last week or so?
Sure. Well, I have been patiently waiting for the update to the leading economic indicators, because that is really something that doesn't, make the headlines. We always see real-time data for CPI and employment, et cetera, GDP. But really that kind of tells you where they think we are today, not where we're heading. And so,
Right.
Economists and the Fed really rely on those leading economic indicators because they tend to show things either going south or going north, a contractionary or expansionary in advance of when it gets into the system real time. We keep hearing, and now we're understanding the term long and variable lags. Like after an interest rate cut, it takes, 12 to 18 months to even see the result of that on the economy. Same thing with rate increases. And so, these things take a lot of time to become real time. Are we in a recession or not? So for example, if you're contracting in the leading economic indicators, it's basically 10 very broad indicators that tell you the overall health of the economy and whether it's overall leading in a positive or negative direction. And what we've seen, we've talked about a bit on this show, is that they first turned contractionary and signaled recession warning in 2022. And so we were all saying like, okay, we're about to enter recession. The LEIs are flashing red. And what you've seen is because of, we've talked about it a bit on the show, a lot of government spending, both parties, both sides, but a lot, post-COVID that continued, it kind of propped up spending. Because when the government spends, Michael, they're putting money back into the system to contractors and to those who are recipients of benefits of some sort, savers when they issue bonds. It's now giving income to people that are buying them to some extent. And so that government spending is really what kept GDP positive and kept the current numbers positive, despite, broadly a lot of these economic indicators coming down. So I watch them to see what's changing. Are we really getting a better economy now, or is it really worsening? And so it kind of tells you what to watch. And so bottom line is today they came out and they went further negative effective September. So there is a delay because of the government shutdown. And so, a lot could have changed obviously in the last couple of months, and I would argue it has. And the question is, what does the data say since then? But these LEIs are an important signal to what the Fed might do, because they're supposed to be forward thinking. So if they're looking at the data and looking at where do the LEIs tell us we're headed, what we can say is that the breadth of the data is telling us that the economy is continuing to weaken. We hit a recession warning signal again in August. It's been recession warning almost all of 2022. Came up in 2023, back down in 23, up in 24, back down in early 25. And so in August, it was recession warning again. September, even though it's gone more negative, is going less negative. So it's just kind of teetering right there at that warning sign, but wasn't technically triggering a recession. And so it's important for us to understand what is still positive. And the things that were positive were the stock market. So the stock market is formally a leading economic indicator, although we could argue whether it really should be and it's really connected to fundamentals anymore or not. The next thing is credit. So stock market's still continuing to be positive. Credit is positive, but it's really narrowing. It's like 0.05% growth in credit. And so, private credit does make a big impact on lending and getting us into more of a recovery or expansionary period. And what we're seeing is credit is still positive, but it's starting to weaken a little bit. And one form of non-military production, manufacturing was positive slightly, although less so positive than it had been. So all the other economic indicators, though, Michael, are negative. And because of that, because we have that data, and then the other thing on my radar is what's continuing to happen in the weakening job market and the weakening number of companies that are healthy. So we're seeing broadly the largest number of layoffs. And this is all from private data because, again, government data is on hold. They've now delayed this week more data that they're not going to come out with. I think it's for October numbers now, where it was delayed. Now it's basically canceled. But the private sector data, the jobs data from multiple different sources, Challenger and ADP that are pretty broad, are all coming out and saying we have more than 1 million layoffs this year. It's the largest since any time other than the GFC and COVID. And we have more corporate bankruptcies than any time since the GFC this year. And so
I want to ask you about that.
And so because of all of that, I do believe the Fed is absolutely going to cut tomorrow. I think they have to. I think they should cut again 50, and we can argue why, but they won't. They'll probably cut 25. And to your intro point, they're probably still going to say we're hawkish. They're going to be deeply divided, and they're going to say we still think inflation is an issue and we've got to counter that, but we think that the employment weakness we want to get ahead of, and it's a bigger issue, so we're only going to cut 25. So that's my bet on what's going to happen. I'm pretty much with a consensus there because of that.
Yeah. So let's talk about the cut first, because that'll be market moving tomorrow. I agree with you, although with my audience, I made a call, I think it was 3 weeks ago, that they're going to pause. Obviously, the data has gone very negative since then, but I don't want to flip flop. But yeah, I think consensus is right, going to be a cut. But again, I don't mind admitting when I'm wrong. So I think that's fair. I think it will be a hawkish cut, much like last time. And this is really going to annoy people, right? The Fed's going to cut, the short end will fall, but mortgage rates likely go up.
And they are today. Again.
Yeah, they are. Again.
You know, with the expectation of a rate cut, they're going up. And that tells you there's a big disconnect, Michael, and the Fed is losing control of interest rates. They
no, exactly. Yeah. And more on that in a minute. The question I have about this meeting is, if I gave you an over under of, let's call it 2.5, that way you have to make a choice, dissents, would you take the over or the under?
Meaning that I think there's going to be more than 2.5 people that dissent.
Yeah. Well, basically, will there be 3 or more is basically the question.
Yeah. You know, I think there probably will be 3 or more that dissent. I think we had more than that were already that have come out publicly before, you know, you had like the quiet period where they can't talk, that are going, hey, we don't think we need to cut. We think we're about where we need to be because inflation is still too big of a risk. So I think that they have, I mean, it's good to see democracy in action, that it's not just whatever the Fed chair says we're going to go along with, like they did under Greenspan and Bernanke. They're being more vocal about their differences. And what it shows us is that this is difficult. And with all deference to the Fed, as many times as I've said, and many have said, they're always behind the curve, and they make decisions too late, and then they end up, triggering, a recession because they didn't act quickly enough. With all of that said, they have inherited economy, respectfully to them, from previous administrations, both sides of the aisle voting for fiscal policy, that has created what we have today. Make no mistake about it, inflation was caused by our government printing money across its Congress, the Treasury, and the Fed, Fed low interest rate policy. And so they have inherited a really difficult economy that, despite what the headlines have said, government spending has propped up the economy when it has been weakening for years now. I mean, we're going on 6 years since those 2022 recession signal, 4 years, I'm sorry, since those 2022 recession signals, because of the mass amount of money printing. They are caught where their tools are no longer as effective as they need to be, because monetary policy is not really driving the growth or the contraction, and therefore it can't really fix it when you have both inflation created by billions and trillions of dollars actually into the US economy, and you've got slow growth. it's like stagflation. It's like what I've been warning about for a couple of years, that my worst case scenario isn't a deep recession, it's stagflation, where we're stuck in this space. And so, the Fed doesn't really have a lot of good choices. And the dissents, to your point, are really a symptom of that reality that, they're darned if they do and they're darned if they don't. If they cut too much, when those that have money are going to keep spending and get excited and go risk on. The Fed sees a recession, they're going to save the system, it's risk on, and they're going to go spend like crazy, and that's going to keep inflation high and maybe higher, and then they're going to have to reverse and raise rates. So those that are on the hawkish side, that's their fear, Michael, as you and I know. But for our listeners, and then those that are going, hey, look at all the data that I just talked about, the decline in the LEIs and employment and recession, they're like, we're on the cusp. If we don't act now, the recession is going to be much worse than it otherwise might be, and that we otherwise might be able to save. And their argument is inflation is transitory. It's because of the tariffs, and eventually the tariffs become deflationary. So I think you're going to have some real good debate. And I think we really need to watch the comments again after the cut, because what they say afterwards is more telling. And then when the Fed minutes actually come out, you'll see those dissents. So I think you'll have healthy dissent. I'm with you on that. I think it's probably 3 or more that come out and say, yeah, we're cutting a quarter, but we don't think we should.
Yeah, I think you're right. I did a deep dive before the blackout period on the 12 voting members, because there's actually 18, but 6 of them don't vote, right? As you know. So what I found is there were 5 doves, 5 hawks, and 2 unknowns. One of the unknowns is Jerome Powell, because he was very quiet for a couple of weeks. And, I for a long time, I thought there might be 5 dissents. I'm actually thinking now there'll be 3 or 4. But this would be a big deal, right? We haven't had more than 2 dissents since the 80s. Yeah. So, again, back to the Fed's job is hard. But I want to go back to something else you brought up, because I hear a lot of people talking about, most bankruptcies since the GFC, 1.1 million layoffs. And I just wanted to ask you, I think a lot of this is just, kind of like pressure in a garden hose. I think there was a couple of years where we didn't do what we should have done. We didn't process bankruptcies. We didn't process foreclosures. We didn't fire anybody because everybody was nervous. So what happens when you unleash that hose, as you know, you kind of get this spike, right? You kind of get rid of the dirty water. That's, and we should have had bankruptcy. We should have had foreclosures. We should have had job losses, but we didn't do that. Now we're seeing a spike in that. Everybody's freaking out. I just look at that going, guys, zoom out. Stop looking at the tree. Zoom out. We had 2 years where nothing happened. You think everybody was running a good business for 2 years? Hell no. We should have bankrupted people then. We're just making up for that air pocket.
Absolutely. No, I agree with you 100%. And go along with commercial real estate. I mean, it's extend and pretend, right? Banks held off as long as they could. They're holding to maturity. They're bad bonds, and they're bad commercial debt, and they're bad corporate debt, and they're holding off to, not recognize and realize those losses. So they're working with borrowers so that they don't have to worry about their own bank balance sheets. So what it says, I would argue, is that, again, the economy has been weak, broadly, most of the economy, not all of the economy. There are certain sectors that have done very well. I mean, look at the services sector. When the top 10% of all income earners are getting wealthier as the stock market goes up, and as treasuries are paying higher rates, and money markets and savings are paying high, they're still spending like drunken sailors. And so the things they've chosen to spend on have gone really well in the economy. But the other areas have started to suffer. So, we've been in broad economic contraction. Clearly, no matter who you are, the data is showing broadly we're contracting across most of the economy for a couple of years. And so, yes, I think some of it is credit is starting to tighten, because banks and lenders, private credit as well, the shadow banking system, they are essentially going, okay, we've got a problem. The Fed isn't going to rescue us and drastically cut rates and allow all this refinance to happen that needs to. We're not going to let people extend anymore, hoping that the Fed's going to cut rates when geopolitically things have changed significantly. And they don't see a justification, one, to the regulators to continue to, not hold people accountable to their loan covenants. But two, they're realizing like, this is not going to be fixed in the next year or two. We can't just let this debt continue and let defaults continue and tack payments onto the back end. Like, we just need to, have a reckoning. And I would argue to some extent, even with that said, just to play devil's advocate, that every recession seems to be that way. Are we going to have a recession declared, Michael? I have absolutely no idea anymore. It should have been declared a couple times and it hasn't been. And the government on both parties doesn't want it under their watch. And we can go to what I think should have been messaged to the public, and that they should allow the recession and just be done with it, but they won't, because midterms are around the corner. No one wants the recession on their watch. So the government's going to keep spending to keep GDP just barely positive and say, this was a soft landing. Forget all the economic pain over the last 4 years. This is a soft landing. We didn't have a recession. So I doubt it's actually called. But what we do see at the end of every contractionary period, when you have a recession, it always seems like it's just suddenly. So did that happen in previous recessions? Like, there's weaknesses and there's just extended pretend, but it just wasn't headlined and we didn't see it. It's like, it always seems to be, everything's great, everything's great, everything's great. See no evil, hear no evil, like ignore all the negative data. It's different this time. And then suddenly everyone's like, crap, how are we in like the worst recession ever? Where did it come from? Well, it probably, cyclically, it always seems to have a huge, escape, the genie escaping from the bottle, like this pent up all at one time. So, it's probably more of the same, but I think, to your point, just the years of extending and pretending this time makes it last longer. And it may make it look worse tomorrow and today than it actually is for one period of a time. But it's been building for years at this point.
No, absolutely. And I think that's exactly what's happening in a lot of areas, and people are missing it. I think pain has been building. We delayed capitalism. Part of capitalism, whether you like it or not, is people lose money and you get washed out. You bust. For 2 years, we kind of tried to hide that pain.
Absolutely.
And that's starting, and it should, right? No bailouts. You did a bad deal. You did a bad deal. Pay up and move on, right? That's part of the system. Right. So I think that's what a lot of people are looking at today, going, oh my God, everything's up. Oh my God. It's like, no, guys, and zoom out a little bit. So let's get to the real question. So we both agree that there'll be a cut, hawkish cut. We also know that the Fed president will change in May. And the biggest question I have for you this morning is, will the Fed in 2026, so anytime in 2026, will the Fed start buying mortgage-backed securities?
I would bet money that the answer is yes. And not just for the reason that most people are talking about. One of the things I'm really watching, and I think this is going to be the bigger driver than just what's happening in the housing market, because that's kind of the question, like, what is the Fed going to do to fix housing? And the administration is working on plans to try to come up with ways to fix housing, because as we've talked about on this show before, anytime you're going into a contraction, it is, I believe, without fail, there might be exceptions to this, but it's generally always preceded by first housing and manufacturing going into recession. And in order to come out of a contraction, whether you want to call a technical a recession or not, historically, both housing and manufacturing have had to lead the way out as well. So they've had to recover. So the government understands this, and they understand there's a huge housing affordability issue, but they also finally realize we're really in a housing recession, not just transactions, but prices coming down in a lot of parts of the country. And they need to get, demand up. And so they're working on a fix to that. And part of that could involve, backstopping, they're lowering credit. If you haven't watched that, credit requirements to get a loan. They're floating, the 50-year mortgage. They're probably going to come out with more first-time home buyer programs,
absolutely,
big down payment assistance. They're going to try to get the bottom first-time home buyer to start buying and help, hopefully ease some of that. But I think buying mortgage-backed securities allows the lenders that are going, oh crap, now we got to issue loans to people that can't afford them. They're worried about a repeat of 2008 by making credit too easy, which we could have a repeat of that, right? And so they're going to want the Fed to backstop more, mortgages with more federally backed mortgages, and the Fed may start to have to buy them. But even just looking at that, I think that loses sight of the bigger picture. And the bigger picture is something I've been talking about for a while, but I'm really just starting to really understand the importance and the magnitude of the potential impact on this. And we've talked about my concern of potential banking crisis. And I'm not saying all doom and gloom, all banks are going to fail, and it's going to look just like the savings and loan crisis of the 80s, where we lost 1,000 plus banks over a 10-year period after the inflation fight of the 70s and asset values hitting the skids. But I'm saying it is possible. And so what is our government done that they've, air quotes, gotten better at, right? They have gotten, quote unquote, better at saving the system when there is systemic risk. And i.e., they're going to come out with all kinds of new programs, Michael, that they're going to call not QE, but they're QE, right? So
QE on steroids
is QE. So we had the bank term, funding program rescue when we had the fail of Signature Bank, and these three banks, I think, that started to fail a couple of years ago. But what we have coming up, Michael, we just talked about the fact that all of this has been held off, and you have all these banks and lenders who have said, we're not going to foreclose on you. Just keep making your payment. We're going to turn a blind eye. We're going to wait. We're going to extend and pretend. Well, that's coming home to roost. And so what you're seeing is not only banks, but what we call the shadow banking system, private credit, which, it's estimated, we talked about on the show a few weeks ago, at trillions of dollars, but it's unknown how big it is, and it's not regulated. But there's a lot of lending, and essentially over the next year, there is about $3.3 trillion of debt that they know of, not including all the shadow banking private credit money, that needs to be refinanced. And it used to be, Michael, that the monetary tools of the Treasury and the Fed and the administration fiscally as well, they would look and basically say, hey, this is pretty easy. If we start to have a slowing economy, we'll just lend into the system. We'll print money, QE. We'll issue treasuries on the short end, non-QE, QE, putting money into the bank system and reserve so that they lend. And we'll cut interest rates. And that'll get, the theory in the economy books is that'll get new businesses to start, and it'll get existing businesses to invest in jobs and infrastructure to create growth in the economy. But what I have since learned, and giving all credit to Michael Howe from Capital Wars, and reading his book and watching and listening to the real-time data. Now, Michael, I was shocked to find that of all lending that happens in the country, all lending, private and public, as far as they know with private, over 77% of all lending is refinance transactions now. Since the GFC, 77% of lending is not new businesses, new companies, new things that are going to grow the economy. It's refinancing existing debt. And what happens with those refinances is most commercial real estate loans and corporate loans are 5-year terms. So they could be a 10-year term, but their rates locked for no more than 5 in general, or their actual 5-year terms, or their 3-year bridge short-term loans with 2 1-year extensions. So what that's done since the GFC is it's created a refinance cycle where most corporate and commercial debt has to be refinanced every 5 years. And it's created this new liquidity cycle, if you will, that going back in history since the advent of commercial loans being 5 years, it happens about every 65 months. Well, what did we all do during COVID in 2021 when rates hit historical lows? We all locked in new rates for 5 years. And so, and then again, when rates were down in 2021 and early 2022, before the Fed went, oops, sorry, inflation's not transitory, we're going to raise rates, we all locked in debt. Well, we saw all the defaults from the 2025 deals that fell through because they couldn't refinance because collateral values are down because of interest rates being up. So when there's a mismatch and there's not good collateral to allow you to refinance, and there's not also tons of private credit from the US, from private, from other countries, enough sufficient to refi all that debt, you have a bit of a liquidity crisis where there just isn't enough money available to refinance all this debt. And what's the so what of this? And what does it have to do with the Fed buying securities? The so what of this is we are coming up with a much larger refinance wall in 2026 and 2027 than what we already saw this year in 2025. And it's even higher in 2028 and 2029 than it is this year. But the highest is 2026 and then 2027 and then 8 and 9. So the reality is Michael Howell's done some projections of what does the TGA account, the Treasury General account, say that they're going to have? What does the Fed say that they're going to do with QE? And then how much debt is available in reserves at banks? And how much private credit is there? What are the countries doing that fund most loans? And every major economy that funds most loans, because it's not all from America, a lot of these private institutions, it's from other countries, every one of them is tightening. And he believes there will be about $1 trillion shortfall if the Fed actually prints, I think it's $20 billion a month in QE. If they do $20 billion a month in QE, then they will still be short and there will be a liquidity crisis. And you'll see a lot more failures of companies and commercial real estate, more failures of the banks that have to write up those assets. And so he believes that we're just looking at what does the Fed say? They're stopping quantitative tightening. They're going to buy mortgage-backed securities. He says, no, they're going to have to print so much money, do so much QE, and some of it will be done in partnership with the Treasury. So watch what Scott Bessent does, where they're issuing tons of treasuries on the short end to pump liquidity into banks and money market funds. I think we're going to see QE in 2026 like we haven't seen other than the GFC and COVID, based on this information. And what does that do, Michael? This is why it's so important for real estate investors to understand that. It means that we will have more inflation. So yes, we might be contracting. Yes, today the Fed's going to go, we're going to try to save the recession and they're going to cut rates a little bit. But, inflation is on the horizon and the bond market knows this, knows that we may need to print more money if inflation comes. And they know that we're going to have to rescue the system. And that's why they're demanding higher rates for US Treasuries, despite what the Fed does today. I.e. the Fed's tools are no longer working, Michael. So watch QE. And I believe that if we have a contraction, rates will be cut deeply and quickly in 2026, but it's going to be short-lived. And so buy everything you can at cheap prices with cheap debt, lock in loans for way more than 5, do DSCRs. It'll give you 30-year fixed, despite paying a little premium, maybe above what you'll get in your local bank. Use it as an opportunity. Don't go, oh gosh, Anna's talking gloom. No, I'm talking if these things happen and data's saying they very well could, this is huge opportunity for us as investors. Again, in a time where we may not have that opportunity over the next several years, if the government's going to print money to rescue a system like I think they might, look at it as opportunity. Buy cheap, lock in your loans, refinance anything you need to quickly. You've got to balance as an investor, Michael, like, oh, I think the Fed's going to cut rates 2 more times, so I'm going to wait on my refis. Well, if we have this liquidity crisis in 2026 into 2027, bank lending is going to get a lot harder. So I'm looking to recast some of my loans even before I think rates could fall further because of this coming credit tightening that we may have. And then if they drop more, great, refinance them again, pay your prepaid penalties, get it done. No big deal.
Yeah. Really what I look at in 2026 is it's not about rate cuts for me. Cause I think if we just have, 2, even if we have 5, between 2 and 5 rate cuts next year, I don't think the long end moves that much. To me, the question is, will they buy mortgage-backed securities? And Jerome Powell has clearly said he won't, but guess what? You're out of a job in May, buddy. And the next one, he's going to say yes. And I think he's going to do a lot more than 20 billion because I think he's going to have to. And at that point, rates crash. Because again, the Fed controls the short end. But if you have a buyer that will buy everything like they did during the COVID, rates are going to go down. And rates could go down a lot. They could. I'm not saying they will. I'm just saying they could. So That's
Yeah,
what
the
I'm looking for.
question is, are there, how much is the government going to have to buy to counteract the bond vigilantes that are coming back and going, we want much higher rates for the
Great question.
duration risk, for
Great question.
having higher inflation in the future. And right now, the bond market, I don't remember the exact number. I think it's like 4 or 5 times the size of the stock market.
Oh, at least. Yeah, it might be 8 times.
Stock market's growing,
Yes, true.
but the bond market is huge, and it's big
Yeah.
institutions, it's other countries, they're buying treasuries. And the reality is, if everyone else says I'm out unless you pay me a lot more for future inflation, then the government's going to have to buy a lot. And the question is, can the US deficit afford the interest payments on all of the debt that we are buying ourselves because no one else wants it?
Great.
And that gets us into this whole question that it's like a self-fulfilling prophecy. It's like you're saving the system today, kind of back to capitalism says quit manipulating the markets because you just make it worse on the other side. Let the recession happen and let bygones be bygones and reset the system. But are neither the fiscal or the monetary side, Congress, the president, or the Treasury or the Federal Reserve, the central banks, none of them want it to explode on their watch. And so they continue to kick the can down the road, and they inevitably make it worse down the road. And so I think we're in a really, really tough, hairy position. And while Haskett, that looks like he might be the next, Fed president, has said, we don't want, zero bound rates anymore. We don't want too much QE anymore. But they're kind of painted into a picture where they just don't have a lot of good options because of this true stagflation-like economy and the US debt that cannot afford any longer without more money printing to save the system. So inflation's in our future. You have to own assets or you will be left behind. And that's the bottom line. Like, yes, it's hard to buy real estate right now that cash flows. You've got to look and you've got to work harder and you've got to go look for things that maybe other people don't want. But if you do not own assets that can go up in value with inflation over the next, decade, forget just trying to time a recession in the next year or two, but what happens after that? You need to own things that are going to hedge against a devalued dollar because of money printing and inflation. And that's things like real estate, gold, silver, and some would argue Bitcoin.
Yeah, I love it. Anna, where can people find you?
You can find me here on your show each week. You can find me on social media at Anna Kelly, REI Mom. And if you'd like real estate or wealth coaching and consulting, you can book an appointment with me on my website at annakellyinvesting.com.
Thank you so much. Have a great week.
Thank you.